So central banks were big buyers of gold. Well, they're buying for security. They're buying an insurance position, long term. Well, if that's your motive, you buy bullion. Obviously, if you're a central bank, you don't buy consolidated Ajax, hoping it goes up 100 to 1. Very wealthy families in the Middle East were buying, and very wealthy families in Asia to a lesser extent than the Middle East. Their motives are long-term and defensive, so they buy bullion. They don't buy gold stocks. So in a way, people don't like it when I say this, but in a way, up until, let's say, the last couple of months, I would argue that it was gold that was out of kilter with economic reality, not the gold stocks. Gold should have been lower, but it was this central bank buying that pushed it up.
Adrian Day, the founder of Adrian Day Asset Management, shares his perspective on the outlook for gold and gold stocks in 2024. Central banks emerge as significant buyers of gold, with Day suggesting that their purchases are motivated by security concerns and a long-term insurance position. The first half of 2023 witnessed record-breaking central bank gold buying, notably by China and Russia. Reports from organizations like the World Gold Council highlighted a remarkable increase compared to 2022, stating, "On a year-to-date basis, central banks have bought an astonishing net 800 tons, 14% higher than the same period last year." Day backs his analysis with historical data, noting that in the last 9 recessions since the late 1960s, gold has increased in value in all but one. He observes that gold stocks have also demonstrated positive performance in most recessions. Schroders, a global investment manager, supports this claim with data showing that gold and gold equities have performed well in 5 of the past 7 recessions, dating back to the early 1970s. A recent report states, "Looking at the returns from 6 months before the start of the recession to 6 months after the end, we can see that gold has returned 28% on average and outperformed the S&P 500 by 37%. Day emphasizes that while geopolitical events may cause short-term spikes in gold prices, they are typically not sustained. Gold prices have risen by more than 8%, reaching a 9-week high of $1,985 an ounce since October 7th, coinciding with the decade-long conflict between Israel and Palestine culminating in a war. Join us as we delve into insights shared by Adrian Day. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
I do think the monetary factors are the most important. They're the most important fundamentally and, for any sort of long-term move. Geopolitics, as we've said before, everybody focuses on geopolitics because typically when you have a geopolitical event, gold will spike, but it's very short-lived. It's not sustained. And that's even true when there's something out of the blue like 9/11. Gold moved up, but it didn't hold up. And that was certainly true of a Russian invasion of Ukraine last year. And this year with Israel's response to the Hamas terrorist attack, there were other things going on. There were monetary things going on. So the monetary is much more important. If we have a stagflation, which I'm expecting, a slow economy or a recession along with stubborn inflation, doesn't have to be accelerating inflation, just stubborn inflation. Gold and other commodities historically, particularly oil, historically have been the best performing assets in that environment. If you look at simply a recession, again, you think in a recession, gosh, do we really want to own gold stocks? But if you look at the history, for the last 9 recessions, going back to the end of the 1960s, for the last 9 recessions, gold has gone up in every one except one, and that was in the 2000 recession when the European central banks, if you remember, were dumping their gold. Gold was down less than 0.5% in that one recession, but in the other 8 recessions, it was up. If you look at gold stocks are up in the majority of recessions. And interestingly, in the 3 where they were down by 2, 3, 4, 5%. The ones that they were up by 30, 50, 187%. And the other thing that I find very interesting is that the gold stocks outperform the S&P in every recession, which goes back to what we were saying earlier about, corporate earnings being squeezed. So I think the lesson from that is, if I'm right, if you expect a recession coming, particularly if you expect a stagflationary period, then you definitely want to have gold. You definitely don't want to be in the S&P, and you probably want to be in gold stocks. But in the U.S., they are so, American-centric. Well, we don't need to go into that. It always makes me laugh when you have a World Series of baseball and There aren't too many countries other than America that are in the World Series. But anyway, that's aside. What other central banks are doing is important. I mean, the US is obviously still the world's largest economy, so it's important. Europe is going to have to start cutting rates soon. You see what's happening in the economy. You see what's happening in Germany, which was the powerhouse. They're going to have to start cutting rates soon. I don't see more rate hikes there. Britain is probably going to keep where they are for a little while because inflation just jumped up. But the next major move will be down. Canada, they've kept rates steady for the last few meetings. And I suspect that, there's been commentary that, we're looking for rate cuts in 2024. So pretty much in all of the Western countries, the exceptions, of course, are Japan, where they're increasing rates. I think it's up to negative 0.5% now, isn't it? Or whatever. But they're increasing rates from very, very low base. And China is also an interesting case because China in the last year or 18 months, has had very, very targeted stimulus, but not broad economy stimulus. I think they want to avoid cutting rates too much. So we'll see what happens there. But yeah, you're absolutely right. But generally, the trend, other than Japan, the trend is certainly not to raise rates and more likely to lower rates. Brazil lowered rates, for example.
Adrian Day notes that the Fed is not expected to cut rates in January, but the probability of a rate cut in March is estimated at 50/50 based on Fed funds futures. According to a majority of economists polled by Reuters, the U.S. Federal Reserve will wait until the second quarter before cutting interest rates, with June seen as more likely than May and less easing forecast this year than markets expect. Since September, economists have generally anticipated the first rate cut around mid-2024. However, after last month's Federal Reserve meeting, markets shifted their expectations, pricing in a potential move in March. This adjustment followed comments from Fed Chair Jerome Powell, who mentioned that a discussion of rate cuts was coming into view. Day anticipates that if the Fed does cut rates without successfully controlling inflation, it could trigger a significant positive movement in the gold market. Gold prices retraced gains following the unexpected rise in U.S. consumer prices in November. Let's get back to the interview.
I think when the market believes that the Fed is going to cut rates without taming inflation, I think we're at a sort of, we're at the pivot point, if you want, right now, because, the Fed's not going to cut in January, but March, are they going to cut or not? It's 50-50 on the Fed funds futures. I would put the odds at 50-50 right now, frankly. I think the gold market is a little bit ahead of itself, expectations for the number of rate cuts and how soon they're going to start. I think on balance, things will change over the next few weeks, and I suspect we'll get a rate cut in March. Once the Fed cuts rates without inflation being quashed, then gold really starts to take off. And you can see that in the last, 4 or 5 examples where the Fed has started cutting rates. Gold really takes off. And let's not forget, the soft landing camp talks about how much inflation, CPI, it's not really inflation, different issue. But anyway, how the CPI numbers and the CPE numbers have come down. But let's not forget, even according to the Fed's own preferred measure, the measure they picked, core CPE, right, which means we don't eat and we don't go anywhere. But a core CPE, we're still 60% above their target. So they haven't hit their target by any means. And I think there's a risk, frankly, of seeing what we saw in 1970, in the mid-1970s, when they slow down too soon and then inflation starts picking up again. Going on, that make me think that, there's a lot going on now. Price of housing in the way they measure it in the CPI is probably going to continue coming down for a few more months. Oil is a key because obviously the price of oil helps determine, influences the price of every good in the store. Every good in the store has to be transported. So the price of oil is a factor. And the price of oil obviously is reasonably low right now. So that's a big factor. If the price of oil picks up, then I think we'll start to see inflation pick up. But at the minimum, I would say inflation is going to be stubborn, is the way I'd put it. We'll likely end the year with higher numbers than we have now. There's a lot of people on the Fed. I mean, the last Fed meeting, as you know, Powell was remarkably dovish. He didn't push back against any of the questions that he received. He had plenty of openings to say, inflation is still at prime, blah, blah, blah. And he didn't do it. Since then, as you know, a lot of other Fed spokesmen, either voting members or non-voting members, more non-voting members, but nonetheless, they've come out and suggested that, the market's ahead of itself. I agree with that. And, we still need to watch inflation. So I don't think they're going to be too aggressive early. But, once they start cutting, then the trend for the next year or so will be to cut. They're not going to cut in March and then raise in May. That's not going to happen.
Gold prices are trading at session highs Friday morning after the latest data showed the U.S. economy grew above expectations, while inflation was more relaxed than the consensus. What key factors should investors monitor closely in the coming weeks to gain insights into gold price movements? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.